Hey guys, it's Kevin here. Today's topic is one that I've gotten multiple requests in my comments and emails for. Everyone wants to know how you determine if a property is worth buying. For me, and I think for most real estate investors, buying property is a numbers game. And by numbers, I don't just mean evaluating an individual property, though we'll get to that. I mean looking at hundreds or thousands of properties to identify ones that meet your criteria. And in today's market, it also means submitting offers on lots of properties before you get one at a price that makes sense. So today, I'm going over the 10 basic numbers you need to know about your property before determining if it's the one you want to put an offer for, what numbers I use in my analysis, and where you can get my calculations. When I'm looking at properties, the first number I'm calculating is rent. Depending on your strategy, say if it's short-term rentals versus long-term rentals, this number could differ quite a bit. But for a given city, I can usually scan listings for a neighborhood, the number of bedrooms, and basically estimate the rent price. For example, in a B and C class neighborhood in St. Paul, where I bought my last place, 2 bedrooms there generally go for $1,150 to $1,250, 3 beds go from anywhere between $1,500 to $1,600, and 4 beds go for $1,800 to $1,900. Once you know your market rents, that's basically your revenue coming in. Unfortunately, the other 9 numbers you care about are all going to be costs, so they're going to just reduce your cash flow. The second and third numbers you care about are going to be your purchase price and your monthly mortgage payment. Obviously, these two are related, but a good rule of thumb for buy and hold properties in smaller markets is rents should be 1% or more of your purchase price. This obviously won't work if you're trying to buy a place in, say, New York or Los Angeles, but I also generally wouldn't usually recommend buying buy and hold properties in those cities anyways. Even in St. Paul, prices have grown pretty quickly in the last year, so I might be looking at other cities or other strategies going forward. Also, with these two numbers, you're going to need to adjust the listing price to account for where the property actually sells for. This actual sell price could be as much as 10 to 15% different from the list price, either under or over. Once you have what you think the purchase price will likely be, then you can calculate your mortgage payment. For investment properties, interest rates for 30-year loans right now are right around 4%, so that's the number that I work off of. The last 7 numbers are all going to be ongoing expenses. Number 4 is vacancy. Since you'll have tenants move out and it'll take a bit of time in between each to turn over the unit, as well as find and place new tenants. So usually I use about 5% as my vacancy number. Number 5 is utilities. So if you have a single family home, this might be as low as $0 because your tenants are usually going to sign up for all the utilities themselves. But for multi-unit properties, it depends on your lease agreement. I do RUBS, which is a way to prorate the single utility account that I have across multiple tenants. But even better would be to have individual gas, electric, and water hookups for each of your units. On multi-unit properties, you can usually ask for historical rent rolls to understand what the historical utility expenses are for your property. Number 6 and 7 are repairs and CapEx. Repairs are miscellaneous expenses that come up with a house. For example, last year, I paid someone to repair and then replace a microwave, for pest control to come and visit the house, and for a plumber to come and fix a leaking toilet and sink. On the other hand, CapEx is capital expenditures. Things break down eventually in all homes, and some of them are expensive to replace. For example, a new roof every, say, 25 years is about $10,000 and up, right? HVAC, your heater, your AC, that's usually about $3K every 15 years. New paint, that's going to run you $2 to $3K every 5 years or so, and other miscellaneous kind of expenses. So usually for repairs and CapEx, I usually budget about 10% of the rent. One thing to note here is that CapEx is going to be very volatile. So you may go a number of years without needing to make many repairs at all, only for 1 year all of a sudden to need to spend a year's worth of cash flow to pay for that new roof and then, replumb your sink. So you have to put aside those reserves so when that time comes, you have that extra cash lying around.
I declare bankruptcy!
Number 8, property management fees. I almost always recommend hiring a property manager for your properties, unless you're in the real estate business full time. Especially for older homes, the amount of headache and time spent fixing issues is definitely worth the 8 to 10% of rent you're paying property management, in my opinion. I found great property managers at that 8% rate, and that's what I continue to use in my calculations and what I budget for. The last two numbers that we care about are property taxes and property insurance. These are costs that come with all homeownership, but investors don't always account for these costs. The amount in taxes and insurance can vary pretty widely from state to state and county to county. For example, if you're in Texas, you should expect to pay at least 2% or more in property taxes. Whereas, a couple states across in Alabama, most counties are at 0.5% or less. And this is out of your purchase price. So if you're buying a $300,000 investment property, you're going to be paying, $6,000 in Texas, but only $1,500 in Alabama. So that can add up. Also, if the property hasn't been sold in a while, the county might undervalue the home. So you'll also need to true up the taxable value, which means that even though the last owner might have paid, say, $2,000 in property taxes, you might suddenly be paying $3,000 after the sale because the property value as assessed by the county has gone up by, 50%.
Well, this is gonna hurt like a mother.
Property insurance, I usually just use some online quote engine to give a quick price, which usually ends up being about 0.3 to 0.5% of the purchase price. All right, so those are the 10 basic numbers that I look at for every property that I put an offer in. Now, this is not to say that I actually calculate these numbers on every single property I look at, because that would be crazy. It's more like, hey, look, this is the number of beds, this is the square footage. So the property price is gonna be like in this range. And so if that price range looks right, then let me go look at the condition. And then let me make some adjustments to the price based on that condition. And then if all of that looks right, then I'll go calculate these numbers. So probably only 1% of the houses that I look at make it past that initial screening to where I actually start calculating these 10 numbers. So that's the secret. These 10 numbers form the basis of my investment return analysis. I can use them to calculate my cash on cash rate, calculate my cap rate, or calculate my total return rate. And the two numbers at the end of the day that I usually care about the most are going to be that cash on cash rate and that cap rate. Just a quick recap. If I take rent and subtract the other 9 expenses, then I usually get my monthly cash flow. Annualize this number and divide that by your all-in costs, which is your down payment plus closing costs, to see what your percentage of your initial investment you get back every year in cold hard cash. So that's cash on cash. Cap rate, on the other hand, is net operating revenue divided by property price. Net operating revenue is just your rent minus your operating costs. So that's usually just everything other than your mortgage payments and maybe mortgage insurance if you have that. Total return also paints a picture of how much non-cash and cash value I'm accruing over some number of years. This requires some assumptions around rent growth and appreciation, but it's nice to know that if I sell the property in, say, 5 years or 10 years, I'll enjoy X amount of equity buildup by paying off the mortgage, Y amount of appreciation, and Z amount of tax write-offs from depreciation I can write off. Of course, since so many of you asked for this calculator, I've added a link to it in the description. I've used this calculator to evaluate thousands of properties, and I guarantee that it's going to be beneficial in your investing journey. At the very least, if you're conservative with your numbers, you'll avoid making the mistake of buying a property that doesn't make sense from the numbers perspective. That's it for this video. If this was the content that you wanted, let me know by hitting the like button. If not, tell me in the comments down below what else you want me to cover. And as always, thanks for supporting the channel, and I'll see you in the next one.